Warren Buffett, often hailed as the Oracle of Omaha, has amassed a colossal fortune, primarily through his tenure as chairman and CEO of Berkshire Hathaway. As of early 2026, he was listed among Forbes' top billionaires. While his career at the helm of Berkshire Hathaway has concluded, with Greg Abel taking over as CEO on January 2, 2026, his investment philosophy continues to captivate and educate. The question remains, how did he do it? To understand Buffett's success, we must dissect his investment approach. Sources like CMC Markets and Acorns confirm his foundational philosophy, value investing. This isn't just a label, it's a systematic methodology focused on finding companies that are worth more than their current market price. While many attempt to mimic his strategies, experts caution that replicating his exact level of success remains elusive, as noted in a March 2026 article by Value Investing Strategy Explained. Buffett's journey began with a strong influence from Benjamin Graham, widely regarded as the father of value investing. Wikipedia notes Graham's early impact on Buffett. During his formative years, Buffett adopted Graham's net-nets approach, which involved buying shares in companies selling for less than their net working capital, as detailed in The Warren Buffett Way. This strategy involved taking activist roles and investing in special situations, marking a highly active early period. From Graham, Buffett also internalized the concept of the margin of safety. This principle, highlighted in The Warren Buffett Way, dictates purchasing investments at a significant discount to their intrinsic value. The Motley Fool further clarifies that a value investor's goal is to buy, for example, $100 worth of a company's stock for less than $100. This buffer is designed to protect against unforeseen business setbacks or analytical errors, a cornerstone of risk reduction. While Graham's principles were foundational, Buffett's strategy evolved. As three main undervalue stock investing strategies explains, Buffett initially followed Graham's asset-based undervalue investing. However, he eventually found that the choices of suitable stocks became limited as share prices grew higher. This realization prompted a shift from purely quantitative metrics to a more qualitative assessment of businesses, integrating elements of growth into his value framework. One of Buffett's most frequently cited rules is, never invest in a business you cannot understand. This conviction is echoed by multiple sources, including Acorns and a November 2025 article on copying his strategy. He claimed this approach allows him to ascertain within 5 minutes if an investment is comprehensible. This rigorous self-assessment ensures that he only ventures into sectors or companies where he possesses a deep operational and managerial understanding. This emphasis on understanding goes beyond mere financial statements. A May 2026 Forbes article states that Buffett's top advice is to focus on high-quality businesses while having a deep understanding of their operations and management. This necessitates thorough analysis, as indicated in a March 2026 piece on his value investing strategy. It's about grasping the underlying economic realities and competitive landscape, rather than just crunching numbers. Buffett is renowned for his buy-and-hold investing strategy, a principle highlighted by a January 2026 article on turning $10,000 into a fortune. He invests in companies with the explicit intention of holding them for an extended period, allowing the power of compounding to work its magic, as affirmed by Money. This long-term perspective prioritizes growth over years, rather than reacting to short-term price fluctuations, a key investing truth directly from Buffett. The Motley Fool emphasizes that Buffett is arguably the best example of the power of long-term compounding. Berkshire Hathaway has averaged an impressive 20.1% annualized return since Buffett assumed control. This incredible performance wasn't solely from massive, groundbreaking deals but from consistently reinvesting operating cash flow and allowing time to multiply returns. He views knowledge itself as something that compounds, becoming more valuable over time. Graham also taught that following the short-term fluctuations of the stock market is pointless, a lesson Buffett clearly adopted, as noted in The Warren Buffett Way. Investor sentiment often drives short-term market movements, making them unpredictable and irrational. Buffett's advice, reiterated in a February 2026 news piece, is to be fearful when others are greedy, and greedy when others are fearful, viewing market downturns as buying opportunities, not reasons to panic. A critical aspect of Buffett's strategy is identifying companies with economic moats. These are sustainable competitive advantages that protect a company's long-term profits and market share. TrustNet, in a September 2025 analysis, notes his focus on quality businesses with competitive moats. These could be strong brands, patents, network effects, or cost advantages, making it difficult for competitors to encroach on their territory, as further explored by Morningstar. Buffett's portfolio emphasizes durable, consumer-focused, and financially resilient businesses. A January 2026 Forbes article on his portfolio highlights this long-term investment approach, concentrated in high-quality stocks. He seeks companies that can withstand various market conditions and economic cycles, ensuring their longevity and profitability. This focus on fundamental strength underpins his confidence in holding investments for decades. Beyond just quality, Buffett's analysis often includes a deep dive into a company's free cash flow yield. According to a May 2026 analysis by The Motley Fool, his strategies rely on accounting math rather than narrative hope. This means scrutinizing how much cash a business generates after all its expenses, providing a clear picture of its financial health and capacity for growth or shareholder returns. Strong free cash flow is often a sign of a robust economic moat. Buffett's investment strategy isn't solely about external analysis, it's deeply internal. The Motley Fool notes that he famously insists on spending a lot of time, almost every day, to just sit and think. This dedication to quiet contemplation allows for deep processing of information, rather than impulsive decisions. He views knowledge as something that compounds over time, and this thinking process is key to accumulating and refining that investment wisdom. Patience is not just a virtue for Buffett, it's a strategic imperative. Morningstar's March 2026 analysis highlights that patience to let an investment bear fruit is a virtue prized by him. IIFL Securities adds that managing emotions and being patient are key to following Buffett's principles. His long-term perspective inherently requires discipline, waiting for the right opportunities and holding steady through market fluctuations, rather than succumbing to fear or greed. Buffett consistently advises against chasing flashy fads or complex strategies. A May 2026 news report on his advice states he recommends staying away from such trends. Instead, he advocates for keeping investment strategies simple, a point reiterated by IIFL Securities. He prefers practical investment vehicles over speculative fads, as noted by Morningstar. This grounded approach focuses on tangible value rather than fleeting trends. Buffett's primary vehicle for these strategies is Berkshire Hathaway, a name now synonymous with his success. Interestingly, Berkshire Hathaway was originally a struggling textile manufacturer, as highlighted by The Motley Fool. Buffett transformed this failing enterprise into a vast conglomerate, owning over 60 companies, including well-known names like Geico, according to a YouTube explanation of his strategy. Beyond its publicly traded stock portfolio, Berkshire Hathaway holds significant stakes in privately held companies. As of December 31, 2025, regulatory filings reveal these included major entities such as Burlington Northern Santa Fe Railroad, known as BNSF, and Geico Insurance, as detailed in a March 2026 article explaining Buffett's value investing strategy. These private holdings represent a substantial portion of Berkshire's overall asset base and reflect Buffett's long-term vision. Berkshire Hathaway's public portfolio offers a window into Buffett's current holdings. As of late 2025, his top 5 direct stock investments included Apple Incorporated, as reported by a January 2026 Forbes article on his portfolio. This emphasizes his preference for durable, consumer-focused businesses. Regulatory filings from Berkshire Hathaway reveal the stocks Buffett has signed off on, providing specific examples of his criteria in action. Despite the apparent simplicity and proven success of Buffett's strategies, few investors manage to truly emulate him. A November 2025 article suggests it's because no. Though the reason is cut off, we can infer it points to the difficulty in maintaining such discipline. As the Decision Lab notes, calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. This highlights the deep commitment required. A January 2026 analysis by Scrab contends that Buffett's investment strategy was systematic all along, with 87% of his outperformance coming from systematic factors. The article concludes that the secret was not simply genius, but rather discipline. This challenges the common narrative of an untouchable genius, reframing his success as a replicable, albeit demanding, application of consistent principles over an extended period. Even the Oracle has made mistakes. A December 2025 article from 5 Traits Warren Buffett Used to Excel highlights that Buffett encourages investors to reflect on their errors and adjust their strategies. He once stated, regarding selling a stock at a loss, the most important thing to do if you find yourself in a hole is to stop digging. This willingness to admit errors and adapt is a crucial, if often overlooked, part of his long-term success. Buffett's approach extends to how he manages Berkshire Hathaway and communicates with shareholders. Morningstar notes that candid communication with shareholders is another virtue he prizes. This transparency builds trust and aligns expectations, fostering a long-term relationship with investors who understand the philosophy behind the company's decisions. It's a testament to his belief in treating shareholders as partners. Buffett's investment philosophy wasn't static, it evolved. Early on, he adhered strictly to Benjamin Graham's asset method. However, 3 main undervalue stock investing strategies indicates he found this approach limiting as stock prices rose. He began integrating fair value for growth concepts, recognizing that a great business bought at a fair price could outperform a mediocre business bought at a bargain. This flexibility underscores his pragmatic approach. Even in specific sectors, Buffett applies his core principles. A May 2023 YouTube excerpt from the 2008 Berkshire Hathaway annual meeting shows Buffett discussing his strategy for investing in banks. While specific details aren't provided in the research, this instance confirms that his general framework, understanding the business, assessing value, and considering long-term prospects, is applied consistently across various industries, including complex financial institutions. A June 2019 article from Morningstar emphasizes that Buffett's investment strategy prioritized thinking like an owner. He views investments as actual companies, not just as fluctuating stocks. This mindset encourages a deep understanding of the business fundamentals, management quality, and long-term prospects, rather than speculative trading based on daily price movements. It reinforces the idea of partnership, not just possession. His emphasis on patience is crucial for allowing the fundamental value of a company to be recognized by the market over time. This patient approach prevents rash decisions driven by temporary market sentiment, which Graham also cautioned against. It allows businesses time to grow, innovate, and compound their earnings, ultimately rewarding the patient investor, as reinforced by Morningstar and IIFL Securities. Full Warren Buffett Value Investing and Stock Trading course outlines general advice relevant to capital allocation and portfolio construction. It suggests balancing active and inactive investment strategies to maximize returns. While specific details of Buffett's current portfolio construction aren't detailed in the research, his history demonstrates a concentrated approach to high-quality stocks, as noted by the January 2026 Forbes article. Buffett views knowledge as a form of capital that compounds over time. The Motley Fool notes that much of his success stems from accumulating as much investment knowledge as possible. This isn't just about reading financial reports, it's about synthesizing information, learning from experience, and constantly refining one's understanding of business and markets. This continuous learning creates an ever-growing advantage. Despite all the quantitative analysis, the Warren Buffett way also reminds us that it is still people who make markets. Investor sentiment, even if short-term, significantly influences outcomes. While Buffett teaches us to ignore short-term fluctuations, he is acutely aware of human behavior and uses it to his advantage, as exemplified by his advice to be greedy when others are fearful. This psychological insight is an unspoken component of his edge. IIFL Securities suggests that individual investors can indeed follow Buffett's principles by focusing on value investing, practicing patience, managing emotions, and keeping strategies simple, even using index funds. This democratizes some of his core tenets, making them accessible to everyday investors without requiring the resources of Berkshire Hathaway. His principles are not exclusive to billionaires. A significant recent development, reported on January 2, 2026, is Warren Buffett's retirement as CEO of Berkshire Hathaway, with Greg Abel taking the reins. While this marks a new era for the conglomerate, the fundamental investment strategies and principles Buffett instilled are expected to endure. His legacy is not just in the returns he generated, but in the timeless wisdom he imparted to generations of investors. In summary, Warren Buffett's investment approach, often called the Warren Buffett way, is a synthesis of several key principles. It began with Benjamin Graham's value investing, emphasizing a margin of safety. It evolved to prioritize quality businesses with economic moats that are deeply understood. The entire framework is underpinned by a long-term buy-and-hold strategy, fueled by compounding, and executed with patience and discipline. So, what can an individual investor learn from Warren Buffett's philosophy and strategies? Toptal, among others, poses this question. The answer lies not in trying to predict the next big stock, but in adopting a mindset focused on fundamental value, understanding, and patience. His method encourages a rigorous yet simple approach, applicable to anyone willing to put in the time and thought, even for starting with modest capital. Ultimately, your Buffett stock strategy might not look exactly like his, and that's okay. The Old School Value website acknowledges that Buffett himself had different phases, from active nets to investing in special situations. The core lesson is to cultivate a deep understanding of your investments, exercise discipline, and embrace a long-term perspective. These timeless principles remain relevant, regardless of market conditions or portfolio size. Buffett's investment journey is a powerful testament to the idea that success in investing often comes from ignoring the noise and focusing on the enduring truths. It's about making good returns and avoiding losers, as noted by a 2018 Reddit thread discussing his strategy. While his specific holdings may change, the underlying logic of his decisions remains consistent, offering a robust framework for navigating the complexities of the financial world. A January 2026 news piece highlights how Warren Buffett once explained turning $10,000 into a fortune for new investors, outlining 3 strategies that still hold up in 2026. While specific details of these strategies aren't fully disclosed in the provided research, they undoubtedly align with his broader principles: value investing, long-term holding, and understanding what you own. It underscores that significant wealth can start with modest capital, given the right approach. Buffett's journey reminds us that investing is a continuous process of learning and adaptation. He didn't achieve his legendary status overnight, but through decades of rigorous analysis, thoughtful contemplation, and unwavering discipline. His willingness to evolve his strategy from purely nets to embracing growth within value shows a pragmatic approach, not a rigid dogma. In an age of rapid information and fleeting trends, Buffett's advice to focus on fundamentals and long-term value remains particularly resonant. Whether it's through actively picking stocks you understand or simply using index funds for broad market exposure, his core message emphasizes a rational, disciplined approach over speculation. His tried-and-true investment strategy continues to offer vital lessons, as Investing.com highlighted in April 2026. With Warren Buffett's retirement as CEO, the leadership of Berkshire Hathaway has transitioned to Greg Abel. While the specific direction under new leadership will unfold, the foundational investment principles laid down by Buffett are deeply embedded. The company's portfolio, emphasizing durable and financially resilient businesses, is a testament to the enduring nature of his strategies, designed to withstand the test of time and market changes. Buffett's impact extends beyond his personal wealth and investment success. His candid communication, emphasis on ethical practices, and significant philanthropy also define his legacy, as a December 2025 article on his traits notes. While our focus here has been on his investing strategies, it's important to acknowledge the broader values that underpinned his entire career, shaping not just portfolios but also corporate governance standards. The Warren Buffett way, as explored by Robert Hagstrom, highlights that his approach is not a magic formula but a disciplined application of core economic principles. From meticulous analysis to unwavering patience, his methods provide a blueprint. While mimicking his exact success is challenging, understanding and applying his fundamental tenets can significantly empower any investor seeking to build wealth sustainably over the long term. One of the most profound takeaways is the importance of investing with an owner's mindset. Rather than seeing stocks as mere trading vehicles, Buffett encourages viewing them as fractional ownership in real businesses. This perspective fosters a deeper level of due diligence, a longer holding period, and a greater appreciation for the underlying fundamentals that drive true value, aligning with Morningstar's June 2019 insights. Buffett's success isn't just about financial acumen, it's also about psychological mastery. The ability to manage emotions, as IIFL Securities advises, is critical. This means resisting the urge to buy into hype or panic during downturns. His famous quote about being fearful when others are greedy is a direct application of emotional control, allowing him to make rational decisions when others are driven by instinct. Despite the vastness of his empire, Buffett's core investment strategies are remarkably simple. IIFL Securities advocates for keeping investment strategies simple, even suggesting index funds for individual investors. This simplicity removes unnecessary complexity and allows focus on what truly matters, understanding the business and letting compounding do its work. It's a testament to the power of clarity in an often complicated financial world. Buffett invests with deep conviction, a trait stemming from his thorough analysis and understanding. He isn't swayed by temporary market sentiment once he's made an educated decision. This conviction allows him to hold through volatile periods, knowing the underlying business value remains intact. His strategy isn't about making numerous small bets, but rather solid bets on a select few high-quality companies, as highlighted by multiple sources. While you may not own a conglomerate like Berkshire Hathaway, the spirit of Warren Buffett's investment strategies can inform your own decisions. By focusing on understanding what you invest in, prioritizing long-term value over short-term gains, exercising patience, and maintaining emotional discipline, you can build a more resilient and rewarding portfolio. The Oracle has shown us that lasting wealth is built on timeless principles. Ultimately, the investigative journey into Warren Buffett's investment strategies reveals a consistent theme: discipline. It's not about finding obscure secrets, but the rigorous, patient, and unemotional application of well-understood principles. As the January 2026 Scrab article suggested, his outperformance largely came from systematic discipline, not just genius. This makes his lessons all the more powerful and accessible.